Hello traders, happy Sunday. This is the second part of the daily buyers algorithm video I uploaded last week. In last week's video, I introduced you guys to the daily buyers algorithm that I built into a private EA that I'm currently using for my trading. Last week we focused primarily on the weekly time frame. We looked at what exactly the EA looks at on the weekly time frame to frame a bias, and in today's video we are going to take a deep dive into the daily time frame and see how you can combine it with the information you had last week to frame your bias on a day-to-day basis. First, let's do a quick recap of last week's video. Last week we discussed the concept of the new week opening gap. The new week opening gap is basically just a range in price between the close of a weekly bar and the opening of the new week. Okay, so that range in price is a new week opening gap, and I explained that a new week opening gap is confirmed initially bullish when there is a close above the gap, and it is confirmed bearish if there is a close below the gap. For example, here we can see that there is a gap between the close of this week and the opening of this week, and at the end of the week the bar closed above it. So that tells you that this new week opening gap is a bullish new week opening gap, right? And in that video I also explained that it is possible for a bullish new week opening gap to turn bearish if there is a close below it. For example, we have some old new week opening gap that I have on my chart from last week's video. If there is a close below a new week opening gap that was previously bullish, there's going to be a change in states from bullish to bearish for that new week opening gap, and vice versa for bearish scenario. Okay, so in summary, what I'm saying is, first, the EA looks at the new week opening gap, okay, checks to see if there is a recent new week opening gap that has just recently turned bullish. Now, if a new week opening gap has been confirmed bullish, I mentioned that there is a 90% probability that the first return into that new week opening gap will ideally not close below it. Okay, so that is, the first return into a new week opening gap will not cause a change in state for that new week opening gap. So in this example here, this gap has closed above this guy, that is bullish, right? So the first return into it will ideally not close below it. So while price is inside of the new week opening gap or below it, you will be looking for long, so the bias is going to be bullish. Likewise, if price should, this, all the examples we have here are all basically bullish examples, bullish situations. This is an example of a bearish situation. Price has closed below this old new week opening gap I marked out on my chart. The first return into it or above it, your bias is going to be bearish, and you can simply target the most recent new week opening gap, which would be this guy. So a short from here to here would be a nice short trade. And likewise, you can look at the most recent price action right here. You can see that the previous week price closed above this new week opening gap, above this new week opening gap, and above this one. So we know that the next, when price goes below this guy or this guy or this guy, you would be looking for long. So all the while that price is below this area, your bias is going to be bullish. Now, initially at the start of the week, remember I also explained from last week's video that there is a 70% probability that when there is a change in state of a new week opening gap, price is likely going to return back to it. So at the start of the week, your bias is going to be bearish initially until price, now you don't have to use all the 3 new week opening gap, but no, I have all three on my chart here. So no, you can use anyone. You can just decide to use just this or just this or just this, or you simply look for a range. Okay, look for the equilibrium of the three, or just draw a line from the high of the previous week to the low of the previous week. Look for equilibrium, and that should tell you which one is more high probability. For example, if you do that, you will realize that the one that falls below equilibrium, this is an information I didn't share last week, but this is a good time to share with you. This and this falls below equilibrium, so you know that this guy and this guy is more high probability. So while price is going below this area, until price touches this area, you know your bias is going to be what? Bearish at the start of the week. This is the opening of the week, so you know there is a 70% probability we are going to return back into this guy, even if we don't get here, at the very least to this guy. So while price is below this area, you will be looking for a long, and you would want to target, you know, maybe this guy or this guy. So that's basically a summary of last week's video. Now, if all of this sounds a bit confusing, I highly recommend watching the previous video. Okay, I provided lots and lots of examples, and I showed you how I use it in the EA and how I personally apply it to my manual trading. Okay, the audio might not be the best, but trust me, the content is worth it. That said, let's move on to the topic of this video. Okay, we're going to look at how the EA analyzes the daily data to determine bias. Okay, I'm going to switch to the daily time frame so that I can show you. The EA uses 5 primary parameters, 5 key parameters on the daily time frame. The first one is the previous day's high. Let me just write them right here. The first one is the previous day's high. The second is the previous day's low, or let me use the current day's high. The third is the previous day's low. The fourth is the current day's low, and the last is the current price. Okay, so the EA looks at these 5 key parameters to determine bias. I'm going to explain exactly how it does this, right? Here is the rule you have to follow. Here is the rule that the EA follows. I'm trying to explain in such a way that you understand that this is exactly something that I built into the EA, and this is my attempt to explain to you guys exactly how the EA works. Okay, so here is the rule. The bias is bearish if the current day's high is greater than the previous day's high and the current price is less than the previous day's high. Okay, I hope that is clear. Let me repeat myself again. The bias is bearish if the current day's high is greater than the previous day's high and the current price is less than the previous day's high. I'm going to show you a few examples on the chart. All right, that is the first rule. The second rule is the bias is bullish if the current day's low is lower than the previous day's low and the current price is higher than the previous day's low. Two simple but extremely powerful rule. Okay, now one thing to also consider is that if none of these conditions are met for the current day, the algorithm goes back one daily bar at a time up onto the 20th bar to check the conditions again. Okay, if both conditions are met on the same day, the weekly bias is going to be used as a tiebreaker. Now let's look at the chart and I will show you exactly what I'm trying to say. Okay, if you take a look at a few examples, okay, let's look at last week for example. We see from here that on this day, let me use a simpler example. That's yeah, this is a perfect example. So you can see that on this day, the previous day's low, remember the rule, the previous day's low is below, the current day. Now on this day, let's assume this is a current day, let's assume all of this price action, they are not visible. Okay, so this is a current day, this is a current price on this particular day. Okay, so we see that on this day, the current day's low is below the previous day's low, current price is currently above it. Okay, now price might not have like rallied up. Okay, so you are looking at price at that very moment. Okay, so the current price is the price that formed when your setup presented itself. Okay, so I'm going to go into this is May 9. Will I be able to see this on low time frame? Okay, let me go to low time frame and show you. I think it's easier to visualize this on low time frame because of the current price. Okay, this current price data. Okay, so let me go to the 5 minutes, and there was a trade that I took last week. All right, this trade right here, based on this exact same information, and also based on the new week opening gap, right? So we see that let me delete this. So this previous days, on this day, this is on Wednesday, this is the low of the day, right? This is the low of the day of this particular day. This is the previous, on this particular day, the previous day will be this guy, this low right here. Each vertical line right here is delineating a new day based on 5 p.m. New York time, right? So this is the previous day's low. Okay, this is the current day's low. That will be this guy here. All right, so the moment price goes back above this low, the bias is going to be bullish. All right, why? Because this day's low is lower than this current day's low is lower than this previous day's low, and the current price is higher than the previous day's low. Okay, now let me explain better. It appears like the explanation is not clear because this is not a very good example to explain. I think this is a perfect example here. Okay, this is on this particular day. Just assume that all the other price action here is not there. Okay, so let's assume that this is the current day, right? This is the previous day. Okay, this is the previous day's high, this is the previous day's low right there, and this is the current day's high, right? This is the current day's low, right? And the current price is a variable that is constantly changing. Okay, I hope that is clear. Now the rule says that if the current day's high is greater than the previous day's high, because this is the current day's high, which is 1.08847. You can see visually, you can see that it is higher than the previous day's high. Okay, and if the current price is lower than the previous day's high, the bias is going to be bearish. Okay, let me repeat myself. If the current day's high, which is this guy, is higher than the previous day's high, and the current price, as when your setup gave you a confirmation, is lower than the previous day's high. So you can see this is the indicator version of the EA, which is available for TradingView. The indicator is going to be published today. I'm going to drop the link on my Telegram channel. If you are not on the channel, I will encourage you to join the channel, all right, because the link is going to be dropped on the channel immediately I publish it, all right. So by the time I'm publishing this video, I am almost absolutely certain that the indicator would have been done and it would have been available on TradingView. However, it's a private script, okay, so you can add it to your charts from the public TradingView directory. For indicators, you would have to click on the link that I drop on the Telegram channel directly to be able to add it to your charts. Okay, so that said, this is when the setup that I use for the EA, this is when it presented itself right here. So at this point in time, what the EA is going to look at is, this is the current price as when the setup presented itself. That is when we had this sell. This is basically a shift in market structure. That is my confirmation for taking a trade after there had been liquidity sweep above a 1 hour swing high. The 1 hour swing high are all these long lines, this guy, so you can see it took liquidity above this 1 hour swing high and above this high, above this swing high as well, and then we see a market structure shift. Now because the current day is higher than the previous day's high, that is the current day's high is higher than the previous day's high, but the current price as when the setup presented itself is lower than the previous day's high, the bias is going to be bearish, all right. And typically what the EA is going to target when there is a setup like this is this previous day's low, all right. So at this point in time, all through the while price is coming here, this is going to remain true because the previous day's high is still higher than the current day's high is still higher than the previous day's high, and price is still below, the current price is still below the previous day's high. So that will remain true until the opposite of this happens. Okay, you can see that on this day, this is the previous day's low, this is the current day's low. Okay, so if price, you can see that the current day's low at this point in time, okay, let's assume all of these are not present, right? You can see that the current day is below the previous day's low right here, all right. It's even happened immediately at the opening of the new day. Okay, so the current day we can see visually from here. Okay, let's assume all of this price action has not yet formed. Okay, so it's not yet on the chart. The current day is lower than the previous day's low, right? However, the price, that is the current price as when this setup presented itself, is higher than the previous day's low. So the bias is going to be bullish throughout all of this price action right here. Now this is not a valid setup because it is outside of the Q zone. Okay, so this is what it looks at on the daily time frame to determine a bias. Okay, now that I have showed you what it looks like on the low time frame, let me go back to the daily time frame so that I can show you a lot more examples, and then I'm going to switch over to my EA to show you also a lot more examples on the low time frame. Now the reason I'm going to go switch over to my EA on MetaTrader is because of the limited data that TradingView makes available. So but first, let me go over to the daily time frame and show you some examples, and also emphasize an important thing you need to note. Okay, so now just visualize what you think is happening on the low time frame. The low time frame, you are going to have things like market structure shifts. So remember that your current price is the price that your setup. Okay, I don't want to assume that everybody is going to be using the exact same setup that I'm using. Okay, so if you want to apply this to your own personal trading, your current price, what you are using as your current price, is the price as when your setup presented itself. All right, and subsequent price, as the setup is playing out, okay, in your favor. Okay, so you can see from this example right here that the current day, let's say this is the current day, all of these are not there, right? The current day is above the previous day's high, so that is the first rule. And the current price, okay, the current price, remember, is the price you saw your setup. Okay, so the current price is below the previous day's high. Okay, your bias is going to be bearish, and your bias will remain bearish until the opposite of this happens. Okay, remember, you are not using this in isolation, you are combining this with the new week opening gap concept that I explained in last week's video. Don't worry, I will show you a number of examples that can help cement what exactly I am trying to say. Okay, so that is an example. Now, the important thing to note is it doesn't only refer back to the current day and the previous day's data alone. Okay, if you don't find, if none of the statements I made initially, what is the statement when I said the bias is bearish if the current day's high is greater than the previous day's high, and the current price as when your setup presented itself is less than the previous day's high. Okay, that is the first rule I gave you for bearish scenario. And I also gave you a second rule for bullish scenario, that if the bias if the bias is bullish, rather, if the current day's low is lower than the previous day's low, and the current price as when your setup presented itself is higher than the previous day's low. Okay, and don't forget, I said you are not using this in isolation, you are combining this with the weekly bias from what I explained last week to actually frame a bias. Okay, now there is something extremely important that you need to pay attention to. Remember, I said if none of this condition, that is, if on that particular day none of this is true, that is, there is no bearish situation, there is no bullish situation, what you are going to do is you are going to look back the previous bar, you are going to look back one bar at a time up onto the 20th bar. Okay, so I'll give you an example. You would be able to see from, let me use this. So let's say when price is here, remember that this is going to be the current day, this is going to be the previous day, right? So on this day, when the market opened, okay, both statements can never be true. Okay, so you are never going to be bullish and never going to be bearish, right? Because the current day's low is not below the previous day's low. So basically what you are looking at is a liquidity sweep below the previous day's low. So you can also look at the statements as if there is a liquidity sweep below the previous day's low and price is currently above that previous day's low, your bias is bullish. If there is a liquidity sweep above the previous day's high and price is currently below the previous day's high, your bias is what? Bearish. So on this particular day, when the market opened, forget this rally here, all of those things have not happened yet. Okay, at the start of the day, you want to determine your bias. None of those statements are true. So what you are going to do is you are going to look back one bar at a time. Okay, so when you come to this bar is going to become the current day, and the previous bar is going to become the previous day's bar. Okay, so you are going to check for that statement again. is there a liquidity sweep below the previous day, which is this guy, and his price currently is the current price, that will be the price on this right here when your setup presented itself, is the current price above the previous day's low, which will be this guy. Now I hope that is clear. Now if none of that statement is true, right, if none of that statement is true, then you are going to move to the next bar. Okay, so this would then become the current bar, and this would become the previous bar. So here we see that the previous bar is not below and it is not above, so both statements is also going to be false. So you are going to move back one bar again, so this would then become the current bar, and this is going to become the previous day's bar. So here we see that the previous day's bar is below, the current bar rather is below the previous day's bar, and the current price right here is above the previous day's bar. Okay, so the bias at the start of this day is going to be bullish. I hope that is clear, right? It looks a bit complicated, but let me go over it again. All right, using let me use this example. Okay, so let's say price is here, right, at the start of the day, or let's say your setup, you add a short or a long setup, whichever one you whichever one presented itself, and you want to determine whether you should go long or you should go short, right? So what you are going to do, this is your current price. Remember, your current price is the price your setup presented itself. Okay, that would be the like the close price of the bar that confirmed your setup, right? So let's say the close price is somewhere, let's say the close price of your setup is like now we can't see what is happening in the low time frame, but let's just use an hypothetical value. So let's say we use the opening of this candle. Okay, so the opening of this candle is that is 1.08745. okay, so let's say that is the current price, that is a price your setup presented itself, that is a confirmation, that is the price at which price confirmed your setup. All right, now you want to determine your bias. Okay, the first thing you are going to check, remember, all of this down move here has not yet happened. This is the open. We don't know if the price is going to go down yet or if it is going to go up. Okay, so we want to determine what the bias is going to be. Remember, just assume that all of this down move is not yet there. So as at this point in time, the only thing we would have probably had is maybe this rally up or maybe not. Okay, maybe whatever. Okay, let's just say the current price, okay, price has not yet closed, price has not yet dropped below here to paint this candle. So you are only dealing with the current price, which is 1.08735. okay, so that is your current price. Remember the rule, this is a current day, this is a previous day initially. Okay, so we are going to check, is the current price, is the current day's price, is the current day's low. Okay, this is the low at this point in time. We don't really know exactly what the low is, but we're assuming that all of this price action has not yet happened. Okay, so the low at this point in time before this drop right here is somewhere right there. So that low is not below this area. All right, so that statement is not going to be true because the current day's low is not below the previous day's low. I hope that is not confused. Remember, you are looking at the price at which the setup presented it. Don't worry, I will still go back to the low time frame. I think it's clearer on the low time frame, right? And then when you compare the bearish situation, you also see that the current day's high is not above the previous day's high. Okay, so we are not bullish, we are not bearish if we use the current day and the previous day. Okay, remember again that we are assuming that this drop has not yet happened, so we want to try to know the direction of the market. So as at this point in time, when you had your setup, you want to determine if you should go long or if you should go short using the daily information. Okay, so now that you couldn't determine your bias, what you are then going to do is move one bar to the left. Okay, so this bar will then become the current day bar, and the next previous bar is going to become the previous day's bar. So when you compare that, is the previous day's bar above, is the current day's bar rather above the previous day's bar? No, obviously the remaining statements won't be true. Okay, and on this day right here, we see that this bar's data, that is the current day's low, this is the low of the current day, is it above the previous day? Nope, it is not above the previous day. Okay, so the rest of the statement is also not going to be true, right? Then we are going to move one bar again to the left. So this is going to become the current day and this will become the previous day. Then we check again, is the current day's high above the previous day's high? Nope, it is not above it. Is the current day's low below the previous day's low? Yes, it is below the previous day's low. And then we check the current price, which should be the price at this point in time. Is it above it? Nope, it is not above it. Same thing applies here. Actually, I made a mistake here. The current day's low is actually below the previous day's low. As when we are here, the current day, this is the low. I was using the close. Okay, this is the, I was using the open rather. This is the current day's low, right? That is the current day's low. It is below the previous day's low, but the current price, which is what we are trying to determine here, is not above it. So we couldn't frame a bullish or a bearish bias on this day, and even on this day. So both of those two rules I gave you are not true. Okay, because on this particular day is not true for bearish because price has not taken the previous day's high. It is not true for bullish because price has not taken the previous day's low. Remember, all of this has not yet happened, so we don't know if price is going to, if the low is going to be below this area. All right, and on this day the low is below, but the current price is below, is not above, so it is not bullish, right? Then we come back to this day. Okay, on this particular day now, this is going to be the current day and this is going to be the previous day. So we check for the bearish situation. Let's check for the bearish situation first. We see that the current day's high is greater than the previous day's high, which is this guy. This is a high, this is a high. So the high, the current day's high is greater than the previous day's high. All right, so that's the first condition for bearish scenario, for bearish bias. Then you will now check it against the current price. Okay, that is the price you had your setup at this, on this current day. So you know that the current price is below the previous day's high right here. So that means your bias is going to be bearish as at this point in time. Now if you check for bullish, you realize that it is not going to be true for the bullish scenario because the current day is not below the previous day. All right, so once the first condition is true, once the first condition is not true, the second condition you are checking against the current price is also not going to be true. Anyways, okay, I hope that is clear. So you can go back in time as far back as the 20th bar. Okay, so that means on this day, if you're set up from somewhere around here, before this low is taken, your bias is going to be bearish. All right, your bias is also going to be bearish somewhere around here. Okay, so this is Very simple. This is really straightforward, and if it is still confusing, I'm sure that by the time I show you a lot more examples on the low time frame when the actual setups are forming and how the EA decides to go long or go short on MT4, I think you would understand a lot better what I'm trying to say. Okay, so let me switch over to MetaTrader so that I can actually show you what I'm trying to say. Okay, so this is MetaTrader. I'm going to do a quick run through 2023 price action so that we'll have a lot of examples to work with on the low time frame. I'm not using trading view because of the limited data on low time frame. Okay, so let me run it from January to 2024, so one full 1 year, just to have something to work with. So I'm going to click on the visual mode is enabled. Let me just check to be sure that the parameters are correct. Regular, use daily bias. You can see the daily bias algorithm is enabled right there, and I'm going to leave the rest at the default. I'm going to enable the break-even 1 hour liquidity sweep 5 minutes market structure shift, and I'm going to use intermediate term highs and lows. Okay, so the rest 1% risk. The rest is just going to be, I'll use the default. Okay, so let me run it. I think, okay, so that is going to run for the whole of 2023, and then we'll have a lot of examples you can work with. I think what I'm going to do is I'm going to combine this with the daily, okay, so that you would see what is happening on the daily as when the setups were forming. Okay, so let me go to okay, let's use this. This is December 26, right? We had the long setup right here, December 26. So I'm going to go to trading view, and I'm going to check this is just pay attention to the current price. Okay, let me see if I can get the current price. That will be the opening of this candle, which is below there. That is 1.10239. so you can see that will be the current price. The current price is the price is presented, the setup. You can see from here there is also a short setup right there. Okay, but it is grayed out because the bias is bullish. So let's determine how it's decided that the bias is bullish and not bearish. So I'm going to go to trading view now and look at the daily time frame for December 26, 2023. So let me go to December 23. This is December 26. This is 26. So this is December 26. So how did he determine that the bias is bullish on this day? You can see that even the indicator version of it is telling us on the daily that the bias is bullish. Anyways, that is not that important. Okay, so inside of this bar, before the market rallied up, okay, as this opening right here, that's somewhere around here, right? You can see that was the rally we saw on the daily. Okay, so right as when this setup presented itself, Okay, it is going to check, it wants to decide that, okay, now we have a setup, is the bias bullish or is the bias bearish? So let me go back to the daily again. So remember, it is going to check the current day against the previous day. It is first going to check, has there been liquidity sweep below the previous day's low, right? You can see on this day there was no liquidity sweep below this low, none. There was no liquidity sweep below this low. So we know that on this day there is no bullish bias and there is no bearish bias, and we also know that as our already set up form, price has not taken the previous day's high. You can see from here, this is the previous day's high. As I already set up form, the price has not yet rallied up to take out the previous day's high. Okay, so we know that those two rules I gave you are not true, both for bullish and bearish situation. Okay, both for bullish and bearish scenario, that statement is not true, right? So what it is going to do is it's going to go back one bar behind. Okay, it is going to check, is the previous day's low. No, now this will now become the current day and this will become the previous day. Okay, so it's going to check, is the current day's high above the previous day's high? Nope. Is the current day's low below the previous day's low? Nope. So that rule would not be true for both the bullish and the bearish situation. For both bullish and bearish bias would not be true on this particular day, right? It's going to go back one bar at a time again, and it's going to check, is the previous day's high, right, that is on the, based on this guy, is the previous day's high above the previous day's, is the current day's high above the previous day's high? True, right? Then is the current price below this previous day's high? So remember, the current price was that will be the close of that will be the opening of this candle, which would be 1.0239. so if you compare that against the high of this guy, the high here is 1.0126, so you can see that it is higher and not lower. So bearish bias would not be true on this day as well. So it's to keep on going back one bar at a time until eventually that bias is true. And where it became true is this right here, this area, this place. So the limit is 20 bars. After 20 bars, it uses just the weekly to determine the bias. Okay, so you can see from here, you can see that throughout all of these price action, there is nowhere any of these bars, there is no, when you look at all of these bars one after the other, there is nowhere the current price, that is the price at which confirmation was gotten here. Okay, there is nowhere it is ever going to be below any of these guys. So you know that bearish bias is not going to be true. Bearish bias will only be true if assuming price comes back to, let's say, somewhere around here and the setup forms somewhere around here, then that current price would now be lower than the previous day's low relative to this bar, and then the previous day's, the current day, which would be this guy, will be higher than the previous day's high. Okay, I hope it is not confusing. Basically, let me repeat myself again. What it basically checks is the current day's high above the previous day's high? If yes, then it will check the price at which the setup presents itself, okay, which would be the close of the bar that confirmed the setup. Okay, in this case you can see that the close of this bar, this is the market structure shift, so the close of that bar is what it is going to use to determine the bias. Okay, so it's going to check is the close of that bar, is the close of the bar that confirmed the setup, is it below the previous day's high? if true, then the bias is going to be bearish, right? If it is not true, it is going to check for the bullish situation, like it's going to check if the previous day's low is below the previous days, if the current day's low is below the previous day's low, and if the price at which the setup was formed is above the previous day's low. Okay, in other words, if there is liquidity sweep above the previous day's high and the current price, okay, the price the setup was confirmed is below the previous day's high, then bias is bearish, and then vice versa for the bullish scenario. Okay, so that is what happened here. Okay, so and then it went long, and it will keep on checking. You can see this is a sell here at the start of the day. This would not be, the bias would not be bearish, because we can see that the current day's high is not greater than the previous day's high, right? If assuming price has taken this guy before this setup presented itself, it would have closed the long, because the bias would then be bearish, because the current day is higher than the previous day, and then the current price is lower than the previous day's high. Okay, so it would have gone short. It wouldn't go short because it's outside the kill zone, but it would have closed the initial long. Okay, you can see another buy setup formed here. It didn't take this long because it is already in a long here. So let's look at a few more examples. You would see that all of the buyers here is bullish. You can see that there are also bearish setups. Look at this arrow. I don't know if it is visible. You can see that there is a sell setup. There is a market structure shift below this low. However, it's grayed it out because the bias is bullish. You can see that there was also a setup here. It didn't go long, probably because it is outside the kill zone, I presume. What time is this? This is, yeah, it is outside the kill zone. This is 12 minus 5. This is, sorry, 12 minus 7. So this is 5:45 New York time. So I'm trying to convert the time zone, because the default time zone is not New York time. It is there is a 7-hour difference. So this is 45 a.m. New York time. So that is why it didn't take the setup. Okay, because it is outside of the queues, even though it would have played out. So you can see that on this day the bias is what? The bias is bullish, because all the short setup that formed, it grayed them out because it is not in alignment with the bias. All right, here we had a short setup here, and the bias is what? Bearish at this point in time, as when this setup presented itself, because this is a market structure shift. You can see that liquidity sweep below the previous day's high, and when the setup formed, the price at which the setup formed is lower than the previous day's high. So that is why this would have been a valid setup if it was during the kill zone, but it is outside of the kill zone. And then you can see that on this day there was a buy setup here. You can see the arrow, but it grayed it out. The bias is not bullish at this point in time. Why? Because the bias is bearish. You can see the previous day has rallied above, the current day has rallied above the previous day's high, and the price at which the setup presented itself is below the current day's the previous day's high. Assuming the setup formed above the previous day's high, it should have been a valid long setup. Okay, so let's look at a few more examples of actuals. You can see that all the short setups here up until 18th, all the setups were mostly bullish. You can see this is bullish. All the setup, this is a short setup, but it was grayed out. This is a short setup here as well, but it was grayed out. You can see how you would, and if it had taken both setups, it should have been stopped out. You can see that it should have been stopped out right here. This is a short setup. If it had taken this, it should have been stopped out. If it had taken this, it would have been stopped out here. So you can see how you can prevent a lot of losing trade if you follow this simple rule. And now it combines this with the weekly bias. Okay, so it uses both, right? So let me look for another nice trade. Yeah, this is another decent trade. Now this is quite an interesting one, because at this point in time, this is December 13th. So let me go back to trading view and look for December 13th so that we can visualize it on the daily. So this is 13th of December. Okay, so on this day, okay, so let's say we don't know what price is going to do, right? We don't know what price is going to do. The market had opened, we had a, I think the first thing that happened here on the 13th was we had this short setup, right? This is outside the kill zone anyway, because this demarcation is 5 p.m. New York time. So this is outside the kill zone. Price, you can see that this is the previous day, right? This is the previous day's high, this is the previous day's low. Okay, so at this point in time that this setup presented itself, the bias is likely going to be bearish, or sorry, bullish. Okay, since let's check. So 19th, is it 13th? Right, that's this guy, 13th. So if we check this guy right here, so let's do it one bar at a time to determine the bias. Okay, so at this point in time, it is first going to check, is the previous day's high, is the current day's high. I don't know why I like saying previous day first. Okay, so is the current day's high above the previous day's high? Okay, remember, price has not yet showed up. We are looking at when this initial setup presented it. So this is the first market structure shift that happened for the day, even though it is outside the kill zone. But let's assume that maybe you don't use ICT kill zone, right? But you want to determine if you should actually take this short setup or not. Okay, so let's go back to trading view again and see. So you are going to check, is the current day above the previous day? Nope, so bearish would not be true. Is the current day's low below the previous day's low? Nope, so bullish would not be true for this day. So it is going to go back one bar at a time. This will now become the current day, this will now become the previous day. So if we check both situation, we see that this is the high of the previous day. As when that short setup presented itself, it was close to the opening of the day. So the current price as when it formed definitely was not below this previous day's low. Okay, remember the condition is the current price as when the setup formed must be below the previous day's low, and the high must be above the previous day's high. High. I'm confusing the two of them together, but I hope you understand what I'm trying to say. Okay, so on this day, the first statement is true for bearish situation because there had been a sweep above the previous day's high, but the price at which the setup presented itself is not below the previous day's high. Okay, if as me we say short setup somewhere around here, the bias would have been bearish. Okay, because that price would be below the previous day's this high right here. But it is not true for the bullish situation, it is not true for the bearish situation. Okay, so what it is going to do again, it is going to go back one bar at a time. Okay, so it's going to check, is it bullish, is it bearish? So if it is bullish, if it is bearish, it's going to paint this red. Okay, if it is not bearish, if the bias is not bearish and instead the bias is bullish, what it will do, it will gray it out. Okay, now this is another setup that presented itself. You can see the close of this bar is, that is when we had the market structure shift. It uses the close of the bar to confirm market structure shifts. Okay, you can see there was a close below this area. This is a market structure shift after liquidity sweep, right? So this close, the close price here is around 1.07823, 1.07823. So it is going to go back one bar at a time. I'm sure that this is what it used, because the price is somewhere around here, right? 1.0823. Let me add it to this, change the coordinates to this bar. 1.07823. So I'm just gonna change that so we know exactly where. So it was somewhere here. That's the price where we had the setup formed, right? So when the setup formed, we can see that it is not below the previous day's low, so it is going to go back in time up onto this area. You can see that this current price, this current day's high, is above this previous day's high, and the setup at which the price at which the setup presented itself is also lower than this previous day's high. So that is why the bias is going to be bearish. That is why it showed bearish here, but it is outside of the Q zone. So that is why it did not take this. What time is this? This is 5:15. Okay, so that is between 5 and 7 o'clock. It doesn't take any setup that formed during that time of the day, because that is outside the typical ICT Q zone. Okay, and then we had another setup right here. That is a buy setup. And what price is this? The close of this bar is 1.07968, 07968. So let me go back and just change this. 07968. Okay, so you would see now that it is going to go back one bar at a time until it gets here. This is where the condition became true, because on this day price has taken liquidity below this low, right, and the current price is above the low that was taken. Okay, so that is why the bias is going to be bullish. Is it clear? I hope it's not confusing. All right, I know if this is the first time you are seeing this, you might need to watch this video a few more times to actually really understand what I am trying to say. Okay, go over the condition I gave you earlier on. Okay, the first thing, on the if that condition becomes true on that particular day, it's super easy. Okay, for example, when we went to the low time frame the other time and I showed you this example, I think it has to be somewhere here. So when I showed you this example, this is pretty straightforward, very easy, because it's happened on this day. But you are not only restricted or limited to that current day and the previous day. It goes back in time one bar at a time until until that condition becomes true, either for the bullish situation or for the bearish situation. Okay, so that's pretty much it. Let me still go over a few more examples so that you would be able to understand better. Let me go to so you can see that it is also possible for each to have a bearish bias initially and then have a bullish bias on the same day. It all depends. The most important factor is the price at which the setup presented itself. If the price at which the setup presented itself is higher than the last daily low that was taken, the bias is going to be bullish. Okay, but if it is lower than the last daily high that was taken, the bias is going to be bearish. It's really that simple and straightforward. Okay, so let's go over let me go to, I think there's a lot of good examples. Let me just, this is December, not a lot of good examples in December. Okay, so I think this is a nice example. Here you can see that this is red because the bias is bearish right here. Why? Because price has taken the previous day's high, and the price at which this setup presented itself is lower than the previous day's high, so bias is bearish. It didn't take the setup here because it is outside the kill zone. Now look at, so all the while that price is below this, okay, this is the high, this red line I drew, that is the high of the previous day. So as long as price is below the high of the previous day, the bias is going to be bearish. Now if you get a long setup and the price at which the setup presented itself is higher than the previous day, the bias is going to be bullish. So you can see that the reason why this is bullish and it marked it as green is because the bias has now switched bullish. You can see from here that there was actually a buy setup here. You can see that gray arrow, but it's marked it gray because the bias is still bearish. Why? Because the previous is high is the current day's high is higher than the previous day's high, and the price at which this long setup presented itself is lower, so that's bearish, not bullish. Okay, so that is why it's grayed it out that nope, that is not a valid long setup. And then when this long setup presented itself again here, it went long and it's marked it as green because the bias is what? Bullish. Okay, so that's a really nice example to understand what I'm trying to explain to you. You can also see the same thing. Now just know that it's not only working with just the current day and the previous day. Okay, it goes back in time one bar at a time and then compares the current day with the previous day's bar. Okay, the current day's bar will be the bar that it is working with at that point in time. Okay, so let me go back to TradingView and show what I'm trying to say. What I'm saying is that if it checks those conditions for, if it checks the condition, for example on this day, right, on this day, okay, it wants to determine what the bias is going to be. Right, let's say there was a long setup somewhere around here, and the price at which the setup presented itself, you can see is higher than this low that was taken right here. This guy is taking this low, that is the first condition, and then the price at which the setup presented itself is higher than the previous day's low. Okay, because it has gone back one bar at a time here. Okay, remember this on this particular day, this is the current day's bar, this is the previous day's bar, but when you check both conditions, you will find out that it is not true for both days. Right, so because we can't, no bullish bias, no bearish bias, depends on when the setup actually presents itself anyways. Okay, so if it doesn't find that condition to be true for that particular day using the current day's bar and the previous day's bar, it is going to go back one back at a time, one at a time, up until the 20th bar to keep checking that condition. All right, so that's pretty much what it looks at. Let me see if I can look for one more example from last year that captures everything I'm trying to explain. Now just ignore those setups. This is June. Let me use May. Okay, yeah, I love this. I love what we have in May. So let me start from here. You can see from here that on this day, okay, if your setup, this is the previous day's low, right? Let me remove this guy. Okay, so this is the previous day's low. Price has taken liquidity below the previous day's low and gone back up. So if the setup formed above this area, the condition for bullish situation will be true. Why? Because the current day's low is below the previous day's low and the current price is going to be above it. Okay, so bias is going to be what? Bullish. Okay, and it will remain bullish until the opposites of it happened. Okay, where did the opposites of it happen? Let's see. Remember here, did it take out the high? I'm not quite sure if it did. What was the high here? The high here is 1.09220. The high here is 916 2016. So 20 is higher than 16, so it didn't take out the high here. Okay, so because it didn't take out the high, what it's going to do is it will go back one bar at a time. Did this high take the previous day's high? No. Did this high takes the previous day's high? No. Did this guy take the previous day's high? Yes. Okay, so extend that high out in time. Okay, if the setup forms below this high, the bias is going to be bearish. Okay, but if it is above it, the bias will not be bearish. I hope you understand this. I hope it's clear now what I just explained. Now let me go to the low time frame on this particular price action on trading on MetaTrader so that I can actually show you. This is May. So let me go to May. There used to be a way to, okay, so this is 2023 0501. So yep, so it started. Now this is a long, got stopped out, and then we had a short on this day, that is May 1. So let's go to May 1. This is May 1. We had an initial short somewhere. That means that short, the confirmation for that short happened below this low. Okay, so let's check. So this is a confirmation. The close of this bar is, the close of the bar is 1.09854. So let me just modify this and change it to 1.09854. So May 1. So you can see that confirmation formed below this previous day's low. So that is why the bias is bearish. Why? Because price has taken liquidity above this high. Because no, it's going to go back in time one step at a time until it sees where there is a liquidity sweep below the previous day's high, and then to now check is the low, is the current price or the price at which the setup presented itself, is it lower than the previous day? That's the first condition. But when you check for bullish situation, this is a candle, this is the day that took liquidity below this line. This is the one you will first find before you get to this guy here. So this is what it to first check for, right? So assuming this setup formed above this guy right here, Okay, remember May 1, this is May 1, this is on this bar. Okay, so the setup formed on this bar, so it is checking both bullish and bearish situation. It is going to check, okay, on this current day, was there a bearish liquidity sweep? Nope. Okay, was there a liquidity sweep above a previous day's high? Nope. It's going to check this guy take liquidity. Nope. Then it's going to move on to the next one. I can see that on this day liquidity was taken above this high, so that would be true. The next thing is going to check is there a short or a long setup? If there is a short setup, it's going to check, is the price at which the setup formed, is it below the previous, is it below the current days, the previous day's high that was taken? If yes, then the bias is going to be bearish, is going to take that setup. Okay, now assuming this setup that formed here, assuming it formed maybe way higher. Okay, this is the line that demarcated the price at which the setup formed, right? If assuming that price is higher than this previous day's low that was taken here, the bias would not have been bearish. Why? Because this day liquidity was taken below this guy and the current price is higher than the previous day's low. Okay, so if the setup formed higher up than it formed here, the bias would have been bullish, the bias would not have been bearish. I hope I've done enough justice to explain this to you. I hope it's clear enough. Maybe we should still go over a few more examples. You can see, maybe let's use the low time frame here. Maybe we'll see. You can see here we had you can see that we had an initial sell setup here on the 2nd. There was a sell setup, but it is not going to take the sell setup because the condition I explained would not be true for this guy, for the bearish scenario. Okay, it is going to be bullish. You can see here when the bullish setup formed, it took it and it held it till, what day is this? This is 2nd. Let me see what happened on the 2nd. This is 2nd exactly. Okay, because on this particular day liquidity was taken below this guy and the setup that formed was above the previous day's low. So you can see that is why this is May 2nd. That is why this is the previous day's low. Liquidity has it taken below the previous day's low, and the price at which the setup formed is higher than the previous day's low. It's easier when you are working with the current day and the previous day's bar, but it's not all the time. On a day where no liquidity has been taken below the previous day's low and no liquidity has been taken above the previous day's high, just know that you would be going back in time one bar at a time, and you'll be checking for both scenario, for both bullish and bearish scenario, to see if that setup is valid. Okay, and I explained that if it is both true for bullish and bearish scenario, if on the same, you are using the same bar and both statements are true for both the bullish and the bearish cases, you will not use the daily. You are going to use what I explained earlier on last week on the weekly bias, using the new week opening gap as a kind of tiebreaker. Okay, I hope that is clear. I think this video is already too long, so I'm just going to go over a few more examples from this low time frame here. You can see that, okay, no short setup formed here, only long setups, and then another short setup, because on these shorts, this is May 4. Let's check May 4. I like to show a lot of examples. I just believe that, you know, when there is a lot of repetition, it just helps to solidify things better. So the price at which The price at which this formed is, the close here is what? That's 1.10747. 1.10747. So let me check the 1.10747. So that's May 4, right? So we can see that that is the price at which the setup presented itself. So it is going to go back in time, one bar at a time, and check. Most likely it is most likely referring to let me see, to which bar. This is Thursday. Let me check again. Okay, this previous day is not higher than the previous day. Oh, okay, now I get it. So on this data, the current day's high was greater than the previous day's high. You can see that this high is greater than this high. Okay, how do you know? This is this day's high. Let me zoom in. You can see this tiny line right there, that is this current day's high, and and this current day's high is the tick line. So you can see that the tick line is above the previous day's high. So that is why it took the shots here. But on trading view, I'm not sure if that is true. When we check earlier on, that was not true. It's lower. So that's the thing with brokers data. Brokers data varies. On the broker that I use to backtest my data here, the statement is true, so that is why it is bearish. Assuming this current day's high is lower than this previous day's high, this short would not have been taken. Okay, so same thing applies here on the tens. This is tens. Nope, this is tens. So here, this one is straightforward. The current day's high is greater than the previous day's high, and the setup price is below the previous day's high. So that is easy. That one is easy peasy, and it is going to remain short until the opposite of it happens. You can see that the next day, all the bullish setups that formed, you can see this is a bullish setup that formed here, but it is going to ignore it, to grade it out, because the bias is still bearish. Okay, so it's going to remain bearish until the opposite of it happens. You can see it held the trade for several days. You can see this is short. Okay, all the bullish setups were grayed out. You can see this is a bullish setup right there. It was grayed out, so the bias remained bearish, and then it closed it here, even though the bias is still bullish because of the there is a rule I added to the EA where it closes the EA if it hits the average daily range, which is this thin line here. Well, that's a subject for another day. And you can see here it took an initial short. All of these shorts and these shorts is outside of the kill zone. It took a short here, got stopped out, another short took the shorts, and then close it here now because the bias is now bullish. Why is the bias bullish here? I can tell, you should be able to easily tell from what you see here. Price has taken the previous day's low. You can see this is the previous day's low, and then the price at which the setup formed is above the previous day's low. So that's an easy, but it didn't take the long because it is outside the kill zone. So that's I've showed you guys quite a number of examples here. You can see this is a typical example of when sometimes on the same day the bias can be bullish and the bias can be bearish. You can see the bullish bias presented itself outside the kill zone. Okay, this is why trading only during the kill zone is extremely important. Okay, I think I'm going to stop here. I've showed you guys lots of examples. I hope it is clear enough. If you have any question, feel free to drop your question in the comment section, or if you're on my Telegram channel, feel free to drop it in the group chat. Okay, I would definitely respond to all questions asked. Thank you for watching. I hope that you find this extremely helpful to your trading. In the next video, I am going to focus a lot more on how you can combine the two of them, the daily, what you look for on the daily and what you look for on the weekly. Combine the two together to actually take real life setups. Okay, thank you guys again for watching. I'll see you guys in the next video.